Good evening, everybody. That's There we go. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms, and I am back to talk about our stock market investment strategy using closed-end funds. Now, to get the normal disclaimers out of the way, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I'm not a financial advisor. I am a strategist, a financial strategist, and I don't speak like the herd. I walk in limited company, and pretty much most oftentimes, sometimes I walk alone. Uh, we have a lot to discuss, and I'm going to try to not drag this out. My intention is never to drag out a video, uh, but we do have a lot to discuss. So I'm going to try to be as succinct as possible as I go through all this stuff. And before I get into that, question for y'all: would you help me hack YouTube and help more people outperform the herd, but also just help more people navigate the market? You can do that by commenting on videos. The more comments, which it would be great to be topic related comments, but the more comments, the better. If you share the video, that tells the algorithm that the video should be seen by more people, and you can like the videos. So positive feedback says obviously that people like the content, and the algorithm should push out the video because people want to see more of it. So if you would help me hack YouTube, I would appreciate it. But then you can also help more people outperform the herd and outperform the market and do better, whether it be times like this where the herd is running scared, or when honestly we're the times we all love to see it when the herd is running rampant and we're in greed cycle and the herd is pumping up our values. So thank you very much. Thank you in general, but also thank you in advance and thank you for your help. So notes for the week. A lot happened. I mean, as we all saw by end of week. Uh, I've said it before, I'll say it again. We should take Treasury Secretary Scott Bessent's advice and pay attention to the 10-year yield, which has dropped since he was confirmed. The Fed controls the short rate, the Treasury and the 10-year control the long rate. And Trump and Bessent are hoping if they focus on the 10-year, then they can accomplish a lot: lower inflation, refinance debt, and a lot of stuff we'll get into. By end of week, after all the tariff talk, the market dipped. And I believe now more than ever that the corporate media knows next to nothing about everything, and that Trump and Bessent are forcing the Fed to lower rates. They're actually playing the media like a fiddle. Um, and I hope you can see that by the end of what I say this evening. All the people who were experts, who told us they were experts on crazy ass college degrees and student loans and this loan and that loan and credit card debt, turned into experts on how it's bad to cut government waste, on how it's bad to save the American people money. And then those people turned into experts on tariffs and the economy at large. At least half of the herd well, the herd in general, that's who these people go to for advice. So at least half of the herd's bell ringers, the people that shout the loudest and tell those people what to do. The herd is somebody who wants to be in the market, but who is unwilling to learn the market and who is unwilling to learn anything about the market. Like you're watching Fox Business or CNN Business or CNN this or ABC that. You're watching somebody else tell you about the market and investing based on what they tell you. You're not doing it based upon your own research or your own thoughts or anything like that. So at least half of the herd's bell ringers are nothing more than trained puppets, and they read a teleprompter. Like you can train a monkey to do that. Of the other bunch of teleprompter jockeys know what they're doing and couldn't care less about the herd or me or you. Like they're intentionally steering those people in a direction for their own gain. They're not out to help you. They're out to help themselves. And I do believe Trump and Bessent are using the herd through their teleprompter bell ringers to force the Fed to drop rates, because if you can control the herd and if you can control the deeper current, then you can really control the swings in the market and you can control the swings in the economy. So the day that tariffs were announced and the market dropped or started to drop, my wife asked me about tariffs in the market overall. She's like, "Hey, what's your opinion of this? Like, why tariffs? And what's your take of that?" I was like, "Well, in and I didn't put it like this to her. Uh, in simplest terms, tariffs are the cost of doing business with different countries. And almost every country has been scamming the American people for at least a decade. I mean, years. So Trump announces reciprocal tariffs. It's like a if this, then that. So, and I saw this in passing. So, like I saw this headline. So whether it's accurate or not, I mean, you know the media, whether it's accurate or not, if I'll say it that way, if Japan was charging U.S. automakers 25% to import cars into Japan, if the U.S. was charging Japan 2.5% for Japan to import cars into the U.S., which means on the Japan end of things, those those companies aren't those companies. Yeah, they're being charged, but it's also the country as a whole. So that's damaging our export system, and it's paying other countries a lot of money to and allowing them to import for here for next to nothing. Reciprocal tariff is fine. If you're going to charge us 25% to export goods to your country, we're going to charge you 25% to import goods to our country. Problem solved. And it's in response, you had a lot of countries balk, like, fine, you're going to do that. We'll do it this way. But so far, and I'll say it again, so far we've seen maybe 50 different countries come to the table and say, okay, instead of just going back and forth in tariffs, like India went no tariffs on the U.S. and Vietnam came to the table and said uh, we want to talk a new trade negotiation. So you're negotiating and improving the benefits for both countries. So as I've said before, tariffs don't increase inflation. Tariffs, quite honestly, terrify the people who've been scamming the system, both foreign and domestic. And watch, the people who yell the loudest against tariffs stand to lose a lot of taxpayer money as well as outside campaign donations. There are foreign countries who are using local people to pay politicians to to chant and yell and scream against tariffs because it's helping it. China is the most notorious. And I can't say that China's paying this, but if anybody was tracked back, I would China, Israel. Um, they're paying local people in campaign money to speak for that country over our country. That's not helpful. Uh, let's see. Tariffs generate income for the originating country, and we need income to pay down our debt. We have a ton of debt. We have almost 40 trillion in debt, and Congress's solution to managing the debt has been to raise the debt ceiling, meaning when you max out your credit card doesn't allow you to gain more debt. They're like, hey, you've hit your max. And you ask, hey, can you push my limit higher? And they say no, because you can't pay what it is. Congress is negotiating their own debt with themselves. Congress is like, oh, we're at 40 trillion. We don't have the money to pay it back. Oh, we'll just increase our own debt limit and then we'll borrow more money. Congress has left unchecked. Congress is bankrupting the US and they're knowingly do it, which is crazy. So Trump's Trump's plan, I won't say hope. Hope sounds whimsical. Trump's plan is to use tariffs to pay down the debt, right? We're going to create an external revenue service, already created, uh, where tariff money goes in, and then that tariff money pays down the debt. Uh, let's see. Tariffs protect American workers and American products. Companies want access to the American consumer. Companies want access to the American market. You can argue the strength of independent markets, but everybody wants to be in the American market. I mean, Temu, all of Amazon products, right? Everybody's shipping stuff here. And that's not to say that other markets don't exist, but everybody wants to be in our market. So fine, if you want to be in our market, you can pay to be in our market. Tariffs encourage American companies to manufacture in the US, and it encourages those companies to help create a local and domestic supply chain that's reliable and readily available. Think back to the lockdowns, and not just the people who binged on products like toilet paper and paper towels and Kleenex and wet wipes that later clogged your drain system. Not all that stuff, but also that stuff. If we're shipping in the majority of those things and then stores run out, in theory, that's a problem. Though I'm quite sure with people's ingenuity, we would fix that problem. But at the same time, if we could not need a global supply chain, if we could make everything in the US and have the US internal supply chain remain untouched and undamaged from something like that, that adds to the strength of our overall economy. It also adds to the overall strength of our market, right? If everybody else is dependent upon a global supply chain and we're not, that helps us out a lot. Tariffs are also great for the country, right? But the swamp doesn't like people doing better than themselves. The swamp cares nothing for the country. The swamp cares nothing for you and nothing for me. The swamp cares about self. That's why those people are advocating for countries and not the US. They're our representatives. We elected them, but somebody else is paying them off. And they're taking that money and our taxpayer money and enriching themselves. That's an issue. But the swamp, in response to all this, sent orders out to their propaganda team, the corporate media, and those teleprompter junkies or jockeys, however you want to say. They've been pumping fear into the herd about the risk and dangers of tariffs. Like tariffs are evil and tariffs are harmful and tariffs are going to crash our economy, all this stuff. And I can see that with my individual interactions with people online. The couple of videos I've responded to, people are pretty crazy when it comes to believing what the news is telling them is true. They can't think for themselves. They just repeat the same stuff. And it's all like hyperbole is things blown out, like regular stuff blown out of proportion. But they are just hyperbolic about all this stuff. And it's like the end of the world. And it's, oh my gosh, it's crazy. They're like echo chamber champions. They have no thought outside of what the TV tells them. They can't see that they're in the herd. They can't see that they're being steered, and they can't see that they're being toyed with. But at the same time, that's also the investment group that we all have to contend with because the herd steers the market. When the herd is afraid and they pull money out, that giant group of investors drops the fear index. And when that investor group is hungry and greedy and searching for money and they're pumping new money into the market, that fear and greed index swings into greed or extreme greed. So if you can control that group, that's a pretty powerful tool. Now, Trump's been talking about tariffs for a while, but in all these experts, apparently nobody took him seriously. And then tariffs finally happened. And like it was planned from the swamp, like it might be coincidental. Me personally, I don't believe in coincidences, but when every single news agency says the same exact damn thing at the start of the day and all day, there's no way you can tell me that that's all coincidence. Everybody says the same exact stuff, almost like it was scripted. So, like it was planned from the swamp, everybody hates tariffs. But quite honestly, I still think we're seeing Bessett and Trump because I think Bessett and Trump are using both the herd, their teleprompter jockeys, and the swamp itself to really steer the direction of the economy to accomplish some other stuff that I'm going to talk about. But yeah, the God, tariffs hit, and then the market went into extreme volatility, and it dropped. And by Friday, It was a significant drop, and currently the CNN Fear and Greed Index sits at 4. Like, that's just crazy to me. On my end of things, I look at it as a buying opportunity. On the herd's end of things, they're running scared because they play the game with a poor set of rules. They're playing the game with these 60/40 stocks to bonds. They're playing the game with single stock investments. They're playing the game with both dollar cost averaging, which I think is good, but also reverse dollar cost averaging. So they're trying to amass all of this money into the market, and they're hoping for growth. And they're not getting it, but they're hoping for growth in paltry dividends so that when the market drops, their growth just gets killed and they have no dividend to back it up. So yeah, it's like we've discussed that we're playing with a very different set, well, very different strategy, but also a very different set of rules, very different set of parameters. So when the market dips like this, I get that it's alarming, but it honestly doesn't scare me in the sense of, oh my gosh, my portfolio went down. It's more of a, like, you have to see beyond the fear. You have to see beyond the both the fear of whatever's causing it, but you also have to look beyond the fear of missing out. Like it's such a great buying opportunity. You really still have to have some reserve of what you're going to buy. So more on tariffs. How do you force the Fed's hand? Because we've talked for weeks about how the Treasury Department itself was propping up the economy. We talked about how the Fed has been propping up the economy. We talked about how the government has been propping up inflation. How do you force the Fed to cut rates? Tariffs. But what does that really mean? Like, how does that really work? Like, yes, tariffs are great for the US, right? Despite what every supposed expert, which if you look at that panel of experts on tariffs, it's the same exact panel for this and the same exact panel for that and the same exact panel for that. How wrong have those assholes been before? Like all the time. So why would you trust them now? So I put it this way on Facebook. It's a fight for the herd. And I am. I'm going to read you the same exact thing I wrote on Facebook, word for word. It's a fight for the herd. Control the herd and their perception, and you control the market and thereby the economy. If you're really at the top of the chain, if you are really the top of your class, like if you are the top dog, you will force the people who ring the bells for the herd to react. So Trump announces tariffs and reciprocal tariffs. So you get presidential pressure on countries. You also get Treasury Secretary, Treasury Department pressure, right? Because they have a role in that too, but they also have a role in impacting the Fed. The Fed will love to tell you they're independent. They're not. They love to do their own thing, but they're also reactionary. So we have tariffs, and the propaganda news on, like, they were all synced up to do it at the same time. The propaganda news comes out and pushes fear and doom, right? And the herd pulls money out of the market because they don't want the crash, which nobody wants the crash, right? Or the dip or whatever you want to call it. Nobody wants that. But the reason why we're continuing to see the volatility and why we're continuing to see the fear and the lowering of the market is because of the herd. The seasoned investor doesn't panic, but that's how much new money was in the market too, right? For all the technology gains with NVIDIA, DeepSeek, and all that, and ChatGPT, all that stuff. That's how much new money was in the market. That's also how much money, almost like fake money, that's how much the Fed and the government spending was propping up the market. So tariffs happen. Propaganda team pushes out fear and gloom. The herd panics and pulls money out of the market. The economy keeps chugging along. It's not slow. There are signs of it slowing down, but it's not. Think of how it's like It's like a skier on a downward slope, changing a different level of descent. It's not like a car slowing down and stopping. The Fed stops printing money. Said that a couple of weeks ago. New Treasury Secretary, new sheriff in town. The Fed, who was quietly printing money and pushing that into the market, stopped. And at the same time, Doge is cutting waste, fraud, and abuse. And you have all these new department chairs essentially cutting all the waste, fraud, and abuse from their departments. So the government spending decreased. So you have the Fed stopping print. The Fed's supposed to control inflation, but they're actually contributing to inflation by printing more money. You have the government spending more and more money, contributing to inflation. Both of them stop and curtail at the same time. Inflation halves. Go figure. So the Fed stops printing money, inflation decreases. Doge does its job. These department heads do their job. Less spending equals less inflation. Inflation halves. Now, the Fed's job, amongst all their other duties and their monetary policies and their goals and this, that, and the other, right? Their job is to limit inflation despite printing more money, right? And to get inflation to a 2% or better level. So if inflation halves, that gives them pause. And with tariffs, right? So we have more money coming in, the market drop, right? And it looks like the economy's slowing, right? The perception of a softer job market, it's getting really hard for the Fed to not cut rates. So if the Fed lowers rates, which I still think is the game plan, force the Fed to lower rates, then the Treasury Department gets to refinance our debt at a lower rate. Janet Yellen, and why these videos are not made for kids, and I really try not to cuss on videos, but quite honestly, Janet Yellen fucked us all. Janet Yellen did not refinance our extraordinary amount, or did not refinance the amazing amount of $7 to $9 trillion at a lower rate. When interest rates were sub 4%, right? And it was like stealing a refinance. We refinanced our house at sub 3%. Janet Yellen did not refinance the US debt of $7 to $9 trillion. And now Scott Bessent has to figure out how to refinance that $7 to $9 trillion of debt outside of paying it off through tariff money. So if the Fed lowers rates, Scott Bessent can refinance $7 to $9 trillion at a much lower rate and save us trillions of dollars in payments, right? All while the job market just hums along. Now, supposedly it's a softer market. Government and unofficial government employees, more of those people entering the market. But recent job numbers say otherwise. The job market is humming along. And if the Fed cuts rates, that means the bond market and the bond proxy market will take off with lower rates, and the economy itself will break open. And you add oil into that, oil, local oil or US oil, where we're not paying to import dirty oil, meaning we're not paying for dirty oil to be carried across oceans, to be refined, to get cleaner oil, to be carried back across the ocean into the US. We're not paying for all that other shit. We're making our own oil and pumping our own oil and decreasing costs there. So you end up with cheaper oil, more oil because we're doing it ourselves, and lower rates, and the economy will break out and roar. And the people who hate tariffs don't want that to happen. So I do. I think Trump and Bessent are schooling the system. They're using the system to school the system. They're using the media to steer the herd, which is something that a Republican president hasn't done for a while, and I hesitate to say Republican because Trump's not a Republican, nor am I for that matter. Uh, Trump is somebody who loves this nation, which makes him a nationalist, someone who has pride in the country. He's doing what he thinks is best for the entire nation. That's just for the current times of political parties that puts him in the Republican Party because the current seat of things, well, y'all know the state of politics. Um, so my theory was, at least on my end of things, my theory that Trump and Bessent are intentionally doing this was reinforced tonight when Trump just retruthed that a message to the Fed: stop playing politics and cut rates. And Bessent recently said this: we could have kept the status quo and kept borrowing and pumping money into the system, but that doesn't help Americans. So to help everyone, and especially everyone who's weighed down with debt, which would be about 50% of America, we're changing the game. So to rehash a little bit, if you imagine the economy like a blanket fort, and you're supporting the roof of your fort with a mop and a broom and some couch pillows stacked up and the edge of the table and some chairs, the Fed was propping up with a broom, right? The Fed was propping up part of that fort with a broom handle with that money pushed into the market. And the government was helping by supposedly spending money, but the Fed was actually pumping money into the market and creating inflation for job security, and the government's pumping money into the market by spending and doing the same thing, creating more inflation. And Bessent's response was, we can't do that. We cannot just keep borrowing and borrowing and borrowing or spending and spending and spending. Like, we have to solve the problem. And I think that's probably the most honest take I've heard out of the Treasury Department in years. And I've somewhat gone beyond my notes. It's as much as the Fed wants to say they're independent, they're not. They're reactionary. So, with the Treasury Department setting limits and actually acting like a sheriff, gosh, they're forcing the Fed into action and they're controlling the deeper current. So you have the herd steering the stock market, but you also have all of these other things. You have Doge and US spending, Treasury working to refinance rates, and then you have the Federal Reserve component and that deeper current that really swings the tide of the overall economy. Between Trump and Bessent, they're really trying to control that tide of things. So the surface narrative of what you hear on the doom and gloom news, that controls the herd and the stock market. Those people, gosh, they look at or the herd itself. They look at that teleprompter crew. There we go, and they don't dig deeper. But that's not you and me. We see more. We understand more. We see the bigger picture. And Trump is the best of the best in both of those things. He sees a much bigger picture than we do, and he plays the markets like a flute. And it is. I still it's Trump and Bessent are playing those people against the market itself, the stock market, and the economy. They're allowing they're allowing the herd to be steered and forcing the herd to impact the stock market, right? And at the same time, controlling that deeper current or flow to impact the overall economy. And if you can control the surface and if you can control the deep, right, you can really swing everything in your favor, right? Besant was like, look at like it. I don't like when the market drops, but at the same time, if we kept doing the same, talk talk to Trump and Best and everybody else, listen to what they were saying. If we did everything else the same and nothing happened, then the economy itself breaks. The US cannot pay back the debt, right? If the US goes bankrupt, that's a problem beyond the stock market. That's a problem that would, gosh, for the US to go bankrupt and not be able to pay back anything creates a crisis no one really knows how to fix. Like, do you dissolve the US and start over? Right. So if we don't want that, I mean, if, but we don't want that to happen, we have to do these hard things. We have to make these hard decisions, right? It's that uh, cyclical paradigm of hard times create hard men, right? And they have hard decisions to make, right? And that leads to easy times. The problem is on the easy times, you end up with easy, soft men, who then create hard problems that you need hard men for, right? And we saw well, we saw part of that circle, and now we're in hard times and we have to make hard decisions that impact people significantly. But at the same time, we're hoping the dip doesn't last that long, and that we can, it's if you can force the Fed to drop rates, then the game changes significantly, right? So I think we are watching a masterclass in leverage and negotiations for our favor. And it still comes back to the same thing. When you invest everything in the market is a risk. And you can look at the strategies in general. You can be rigid in your strategies, like it's a 60-40 split of stocks to bonds. It's my 4% rule. It's this, it's that. Like that doesn't work. It's you have to play the current market. You have to have a winning strategy, but at the same time, you have to play the current market with a long-term game in mind because volatility is throughout, right? So if you can find the best deals in the current market that give you the best potential for long-term gains, that's our strategy, or maybe one of our strategies. The biggest strategy is using closed-end funds, buying stuff at a discount. We look at dividends. We want growth, but we're not solidly focused on single company equity growth, right? So say inflation drops to zero, and the Fed tells us inflation is at zero. I don't believe what the Fed says. I think inflation is always higher. So if and I've used this example before. Someone tells you to buy Apple because it'll be worth 10 times more in 5 years. Okay, well, that's 2% a year. Okay, even if inflation's zero, supposedly, inflation's really at least 2% a year. So even though your stock value is 2% higher, your money is now worth 2% less with inflation. So you're at break even, right? And maybe Apple pays a dividend or maybe not. But if it is a dividend, gosh, it's a shitty dividend. Nothing you can scrape a living off of. But if we can buy a closed-end fund, and I wouldn't buy growth stocks or consumer stocks or however you want to define that right now, but you could buy a closed-end fund that has Apple that will see some growth in that time frame, but at the same time, they're going to pay you the majority of your earnings and dividends, 8, 9, 10% in dividends a month. That's a much different strategy than hoping for gains in a tech company that really isn't going to grow your overall wealth. So if you can pay attention to the game and see a bigger picture and you can play the game as it's dealt, like this is the market. You can run you can run scared like the herd, or you can see it as a buying opportunity and use the buying opportunity in the best way possible. Like take full advantage of the buying opportunity. You can ride that gravy train to 8% plus dividends a month, and you can build wealth off the herd's fears or whatever the teleprompter tells them to fear. So where does that leave us? I think I've rambled long enough. Where does that leave us? And if you've been following me for a while, and if you've been following what we've been doing, or maybe copying what we've been doing, then you're kind of ideally prepped for a slowdown or brief recession, right? And is it really going to be a recession? I don't know. I don't think so. I still think we have that no landing recession possibility in play, but it seems the plan is to have it slow down briefly enough for the Fed to lower rates, for Besant to be able to refinance a ton of money, right, and save us trillions, right? And then more oil comes available, and then the economy turns over. So, should you buy right now? And I don't want to sound wishy-washy. Buying right now depends on you and your money and your positions. It's really hard to look past the extreme fear time and not buy. But I also don't want to get sucked into that fear of missing out, right? Or trying to time a market's descent. And so the market dropped, right? Maybe we're at the bottom, maybe not. Maybe you buy and that drops another. I don't know. But buying in extreme fear and like buying our current portfolio, almost everything is a dollar cost average in that regard. Um, so it of our timetable, we bought 2 weeks ago. In theory, we shouldn't buy for another 2 weeks, but it's really hard to look past the dip. Like it's really hard to look past the dip. We bought 2 weeks ago. We should buy in 2 weeks. We could buy now and then not buy in 2 weeks. We could buy now and the market could drop further. And in 2 weeks, it would be even, I mean, yeah, it'd be a further descent, but it'd be a better buy in 2 weeks. So it's stuff that I have to weigh out. Trump said last week, it's a great time to get rich, which tells me he's not anticipating that it lasts long either. Right. But I just think we need some overall awareness. I think we need some reserves, right? Depending on how the market swings. I think you want to focus on data and not emotions. And your individual strategy is so important, but it's just as important now as it ever was. Right. So if we're buying, and I got to figure out if we're buying this week or next week or in 2 weeks, where would we invest and why? Consumer stocks? No. Heck no. Way too volatile. The trade war is going to have companies going at it back and forth. Tariffs are not inflationary, but they're going to force companies to compete. And we like that. Pure capitalism is companies competing for your service. The flip side of that is the herd is running away from those things and those stock values are dropping. So I want to be where the herd wants to be before the herd wants to be there. Meaning we've been buying, and I've been advocating for bonds for at least 6 months, if not a year. And with this type of stock market and in the current economy, which is not taken off like it's doing better than we were 3 months ago, but it's not that roaring economy we saw in 2018, 2019 yet. So if I'm in the herd and I'm not, and I'm trying to find consistent income, something that'll pay me regardless of what the economy does, because I don't want my money to get devalued any further when it's already been blasted apart. Then I'm going to look for bonds or secure dividends, and that's outside of consumer stocks. So we're already there. And now that the herd seems to be running from all these single stocks, they're going to look for these other options. That's kind of a great time to go around the herd and buy up all these other stocks cheap. But at the same time, that gets into the overall timing of the market. I think our consumer market's going to continue to be more volatile than the rest of the market. And I don't volatility in the sense of how it is doesn't bother me based on how we're invested. But if we were invested in just everything stocks and not bonds and bond proxies, I don't know, maybe I would stress more. So it's kind of like it's maybe like a yellow flag, like, hey, pay attention to this, but maybe not a red flag or a green flag, however you want to define it, as like, hey, pay attention, not so much, hey, buy this right now. Tech kind of goes into consumer, but it really is its own category to me. If you can scoop a deal, which there is a deal, and it is all stocks, but still probably not. Oil is a bond proxy, but it's the same thing. It really is its own category because it factors into every aspect of the market and the economy. If you can control oil and control your own oil supply, the market roars. If you are dependent upon somebody else's oil and all the fees that roll into that, that really, gosh, it really cuts you off at the ankles, if not the knees. But with the dip, there are some oil companies back on discounts. That makes it interesting. Natural gas is still well above the $2 mark. Bonds, yes. Straight out, yes. If rates drop, which that's the direction of things. So if rates drop, bonds are a great place to be before rates drop. They'll do better when rates drop. And I want to already be there. And that's why we're already there. And with the herd coming in late, right? The herd, man, like a um, like a bad truffle pig finally finding a truffle. The herd's going to look up and look for bonds and these other things, and they'll finally find secure dividends. They're going to pour into our accounts. They'll close discounts. They'll raise overall prices. That's what we want. Um, energy transfer utility, which kind of blends into oil, but it is its own thing. Still a bond proxy. So as do bonds, so do bond proxies. With the country's need of electricity and our increasing AI needs, the grid, everything we currently have in place, we need energy. And if you can find discounted energy, that sounds really good. And then last, real estate, which is another bond proxy. So with rates poised to finally drop, real estate looks better and better. And I get like the market blipped and everything got impacted. I get that. But if you throw in cheaper cost, more oil, slightly lower demand through ISIS deportations, and slightly more supply, we're set up for a real estate boom. And I mean, my caveat to that, or my 2 cents with that, is I just don't want my property taxes to go up again because my value went up again. So gosh, talk longer than I intended. Um, and I honestly don't know what just happened to my closed-end fund list. Like my closed-end fund list just got decimated. I am super confused. I am super confused. It's like somebody wiped my closed-end fund list. This is crazy. Um, it's the fun thing of live video. All right. So I quickly troubleshot my closed-end fund list. Let's share that screen. So I updated all of this weekend. Um, and without getting into everything, because I've already talked a while, take our triple asterisk funds, drop them in here, And well, I'll explain this a little bit. So the triple asterisk. So everything with a triple asterisk, unless the company's been around for a short amount of time, every triple asterisk is greater than double the historical discount and greater than the 5-year discount. Um, Meaning, gosh, 63% off is kind of like paying 37 cents a share. And if you come down to break even, which is a little skewed, break even is for every dollar invested, you're paying a dollar a share. For every 22, 22% premium for every dollar invested, you're paying $1.22 per share. On the flip side, for every dollar invested, you're paying 37 cents a share. So yes, it's significant, but all of these have significant discounts based upon the overall average of the fund. This one reformed 2 years ago, so I get that 9% is not greater than 6, but there's a little more leeway based on the age of the fund. So we come to this week. So dark blue we own in a Roth, light blue we own in a cash brokerage account, olive or whatever color that is to you, we track for any number of reasons, and purple is recommended by somebody I trust. So they're all targets, they're all significant discounts. Next, we want secure monthly payers. So we want to scan out everything, which ADX next dividend gets paid in May. Next X dividend date, I believe, is in May. So maybe, I don't want to say it that way per se, whether we bought it this month or next, I don't know if we will buy it next month, to be honest. I mean, I mean, honestly, it's the dividend. ADX has consistently trended higher than the market. It continued, I mean, outside of blips, right? It continues to go up in value, and they've actually restructured their dividend program. It used to be 5 cents, 5 cents, 5 cents end of year dividend, almost like a special dividend on top of the 5 cents. But lately they've changed the dividend policy. The current May dividend is still scheduled to be 5 cents. But if you can hold on to it, you'll get better dividends as the year goes on. And I didn't want to own it and then go 2 months without getting a dividend. I like monthly dividends. Um, if you look at quarterly, I mean, if you as an annual, well, yeah, problem for later, but I want monthly dividends right now. So now that we're monthly, now we can focus on general yield. I like to focus on 9% or better unless you can find somebody or justify something that's not as high as a dividend. Not, man, it's late. I'm tired. I like to look at 9% dividends unless I can justify buying something with a smaller dividend. So KYN is an oil and master limited partnership, and they're into oil, energy, utilities. Depending on portfolio. So we own this in an individual account we have through Webull. Our average share price of buy price is $9. So if we bought this in Fidelity, if we bought this in a Roth, we'd be buying it for higher than what we already own it. I don't like doing that. I'll do it, but I don't like doing that. I would much rather dollar cost average lower than dollar cost averaging higher. I tried to transfer our Webull accounts to Fidelity. Webull caused some issues. So I have to call Fidelity and figure out how to do that. If I can actually transfer those portfolios, me personally, I wouldn't buy KYN because we already own it at $9, and buying it when it's 2.3 higher, honestly isn't that helpful for us because it changes our dollar cost average. It's also less than 9% dividend. RFI we own in our Roth. It rarely goes on discount, so it's tempting when it goes on discount. 1129, I think, is still higher. And yes, this is our actual portfolio. 1129 is just higher than what we bought it for. Doesn't It'll change the buy price a little bit, but not a lot. Uh, D&P is actually in negative territory, like discount territory, and that doesn't happen. Like normally, we're looking at D&P as a positive. When we bought it, it was 3% over, which I don't like buying companies when they're in premium. But when D&P drops to sub 52-week average, depending on how sub you want to go, that's a fantastic time to buy. But right now, it's actually in discount territory, and the discount exceeds the 1 year low. So that would stay on the list. Let's see. NML we own in the individual count with Webull. It's the same thing. I think it's $1.60 higher than what we bought it for. And if we can transfer the portfolio, then I wouldn't buy it. Uh, let's see. PHT is bonds. And yes, it's above 9%. So when I scan funds, it's both in relation to what we already have, what we don't have. But if we're going to add something new, then it has to give me something more or be a better option than what we already have. Because I say this often and because it's true. Over diversification doesn't help you. Diversification for diversification's sake doesn't help you. It's my complaint with HGLB at the moment. I would buy it as a dollar cost average, but I'm not a huge fan of their portfolio because they've over diversified the portfolio in my mind. It's Bilbo Baggins' comment about how stretched he felt wearing the ring. He just never realized it was about the ring. He said, I feel like butter scraped over too much bread. And diversifying for the sake of diversifying doesn't help you. It's spreading your money thin everywhere and not giving you enough room to grow anywhere. We already own several bond funds. Owning another one doesn't really help unless it's insanely beneficial. It's I love the DSL fund. We own it we own it in the portfolio with Webull. If we could transfer that money over to Fidelity, it would be a great pickup in Fidelity. But to buy it in both Fidelity and the Webull account feels redundant. We've done that with some other funds in the Roth and our other accounts, just based on current economy and all of that stuff. But a lot of this is going to really come down to us being able to merge portfolios. And if we can do that, then it would probably change what we buy. Um, Cohen & Steers, we already own this Cohen & Steers. They own similar stuff. So it's kind of redundant buying another Cohen & Steers that does very similar to what we already have. Um, Bond fund we already have. Double Line DLY is the sister company or a sister company to DSL. They both pay decently. Um, Neither has raised their dividend in a while, but we already own the sister fund. TEEF, it's a solar company that acts more like a utility company. Everything they own requires oil in order to function. But if you talk to the company or if you read the company manifesto, they hate oil, which doesn't make sense. People will buy it, but it doesn't make sense. These two are straight stock funds. Highland Rate is real estate. It is super low at the moment. This insane discount that I still think is undeserved. Stocks. This is a hybrid account. where it's bond heavy, but it's bonds and stocks. It's utility heavy, which I like that idea. This is technology, and it's I think lower than where it's been. Let's see, we bought it in the Roth, 1162 in the Roth. So yeah, so if we bought more of it, it's it's a great dollar cost average, meaning like our average currently is 1162 inside the Roth. At $11, it lowers our overall buy-in price, but it goes into volatility. Do I think it'll drop lower? I don't know. Do I know the market's going to be really volatile for a while? Yes. So it doesn't it as tempting as it is, it doesn't play to the strategy. CIF, uh, I've talked at length between this company and this company, between FCO and CIS. I like them both. They both pay great dividends. CIF is more of a roller coaster company, and FCO used to be a private company. FCO's trend has been slow increase of value, narrowing discount, versus CIF has been kind of this pattern. And while I'm happy to ride the roller coaster to a degree on CIF, I mean, and I think a lower rate market will help them a lot. It'll help everybody. Um, I still think overall this is a better company because it has the private lending capacity. Um, Steve Besant is a small business guy. The Trump economy is it's working for all of America, but it's also focusing on the middle swath of the pendulum. It's so 50% of America. We're going from like no money to top of the top. 50% and up, which would include like no income, government income, which is still no income actually. Like you have no income at all. People who are living off government assistance, which means we're paying for them. Super low income. Uh, so like first year employee, some experience, first real job, middle income America. 50% of that group, 50% of our group has a ton of debt, but not a ton of assets. And the upper end of things, say between, I guess, so there's like the top, what was it, the top, like 10% owns 80% of the market. So then the 40% under them own, yeah, well, I'm going to get my stats wrong. I don't like getting stats wrong. But between Trump and Besant, they're business guys. They like private lending to, uh, yeah, loan to businesses. I get that, but in trying to spur the economy for everybody. So having a private lender capacity in your bond fund or in your bond company is more valuable in a sense than just having a bond company. PDO is bonds, but at the same time, we already have a lot of bond funds. It's on discount, which is rare, and it's greater than the 3-year discount. That's super rare, super rare. So a PIMCO fund would be a definite thing for us to consider. It is a bond fund, uh, and we already have bond funds, but it gives us a different lion than the others. Let's see. High yield credit fund, bonds and bonds we already have. Saba I like. It's a bond fund, but they also have stocks and crypto and um, minerals and They're an activist fund where they fight for shareholders. I like that. River is a mixed bond fund. It's not really better than what we already have. Highland Global, I like the company, and it used to be, yeah, 12% bonds, and then the rest was pretty split between real estate, utilities, and energy, and that was it. And then they filled in the gaps. Like all the other categories now have something else in them. And it's like, are you diversifying just so that everything has something? Or are you diversifying like 1% in consumer doesn't really, that's just, it strikes me as diversity for diversity's sake. So if we bought it, we would pick up 100 shares simply because I like roundness of numbers. I like buying in sets of 50 or 100 because it makes the math easier. But I mean, and maybe this sounds petty, maybe this sounds insane or crazy. I would buy it just to push it to a 500 point, but at the same, which doesn't go with great strategy, I will admit. Um, and it's a great dollar cost average buy for where we currently are. Um, yeah, just I got off track. I could find ways to justify it, but at the same time, yeah, and selfishly, I would justify it with I wanted to even it out to 500, but I hate diversity for diversity's sake. Just doesn't make sense to me. Um, Western asset doesn't. It sounds great. It looks amazing, but it doesn't beat the benchmark or junk bonds. Eagle Point is a collateralized loan group, as is OXLC. Um, and ECC is generally like ECC has been in crazy premium territory, right? So my ongoing note, almost the past 3 years has been considered a buy when in discount territory. So to have CLOs and uh, and senior loans as well as collateral and CLOs and senior loans and have CLOs, it's it's tempting to have two top of the line CLO funds. So yeah, a third CLO fund. But now it's diverse, we're loading on funds that we already have. Is that diversity for diversity's sake? I mean, we could just invest more here as opposed to buying two more funds that do the same thing. One additional, maybe. Two additional, I don't know. The bond funds are all slightly different. Bonds and private lending, bonds plus additional assets. PDO is a PIMCO fund. It would be bonds, but structured a slightly different way. Um, let's see. Meggie is a utility fund with this note. So if the discount eclipses the year discount, then maybe it's a good buy. It's also a term fund. So we bought it 2 weeks ago and it was below, but now it's more significantly below. DSL I talked about, CTR I talked about. I wouldn't buy DSR or I wouldn't buy ZTR. Here we go. Uh, we're, I mean, I'm honestly looking for a time to sell it. So based on strategy, so we're looking at bonds, loans, BDCs. Oil is actually, come on. Oil is green, but at the same time, the company doesn't meet the objective. So bonds, loans, BDC. bond proxy, utility, energy transfer, bond proxy, real estate, bond proxy, oil. Maybe I said bond proxy. That's supposed to be bond proxy. So we have real estate, utilities, real estate, different ways to do real estate. Um, let's see. Duplicate real estate funds doesn't make sense. Real estate imagined differently. So with like American Tower, Crown Castle, industrial storefronts versus healthcare, um, consumer storage, consumer living. Uh, Instead of having a housing community of single family owners, it's a housing community of homes to rent as well as single family rentals. So, or as well as single family owners. Very, very interesting take on real estate. Let's see. Utilities and utilities, just different ways to do it. Um, I want to say I think it's DNP. DNP has a railroad industrial component. So you look at utilities as well as the transfer of utilities. A lot of people think of pipeline, which I mean for natural gas, obviously, or just getting oil from one place to the next. They think of pipeline, but a lot of people forget about the railway industry, and I think that's key. Bonds, bonds, private lending, bonds and other assets, CLO, CLO and senior loans, plus they sell the covered calls to generate income. So I think that's the list. And if I try to generally parse this out to 4 or 5 companies, but at this point in this market, almost anything you pick is going to be a great thing. It's that weird advice. So if you have an existing portfolio, almost everything was negatively impacted by end of trading on Friday. So almost everything will be a dollar cost average. The question is, how do you use the current market for the long game? If you're just simply dollar cost averaging because you already own it, whether it's great for the long term or not, that's not exactly great strategy. I get your strategy, bringing down your overall buy price. I get that. But where's the best move for you in this market that will also help you in the long game? If rates drop, all of these things have the opportunity to go up. These things might be more volatile with a softer labor market, but I think that's perception because these trend with the labor market. Uh, but I think that's perception. But then again, we all have to factor in the herd's perception of things. Uh, it's both. Yes, that's a fun. Gosh, that's a fun dividend. But can they sustain it? And as of everything right now, yes, they can. Who knows what the coming economy? I mean, if the economy, it's all if, right? It's all risk. We want brief dip for the Fed to lower rates, for the Treasury Department to refinance debt, for more oil to be made available, and with lower rates, the economy will take off, right? Regardless of the labor market. So yeah, anything else is just browbeating a topic. So that's the list. Um, could I really could I really trim it shorter? Maybe with more time, but I don't want. I mean, I don't mind talking through my strategy of things. It's also I don't want to waste your time and talk to you more and really parse this out. I got to figure out if we're going to buy now or in a week or in 2 weeks. Are we buying tomorrow? No, because I have a lot of thinking to do. Uh, if we bought, what would I buy? Bonds and bond proxies. Oil doesn't make the cut. Real estate makes the cut. Utilities make the cut. CLOs make the cut, and then these bond funds make the cut. I would lean toward what we already own because if I picked up which DNP we do already own. I got to change that color scheme. Uh, I would lean toward what we already own because of that diversification principle. Um, Over diversification doesn't help. It's butter scraped over too much bread. So could I really justify adding a different bond company? I don't know. Uh, to decide, I would pull up their file on CF Connect, which I found kind of lacking lately. Uh, their site is not completely updated. Some of their discounts are actually incorrect. I would pull up their files. I would pull up the say ECC and PDO on Morningstar and see what I could get into free, and then I would try to find their websites and dig into their current portfolios and see what they really own. And if they own a lot of, it's like you can be, I mean, between discounts and rates and amounts, it's not that because it's all dependent on when you buy. But if PDO mirrored the same funds that are in DSL, despite having different logos, like Jeffrey Gundlach runs DSL and Double Line, Dan Iveson runs PIMCO, and they're both geniuses in the bond fund world, like geniuses in the bond fund world. And we want them to do the job for us because we reap the benefits, company buy-in, access, and dividends. We reap the benefits and we get them on discount. So we want that to happen. But honestly, if it's a mirror fund, then I'm buying the name to get the same thing I already have with somebody else. And quite honestly, I can get DSL cheaper than PDO right now. So if it's the same exact thing, all I'm buying is a brand and I'm paying more for it. Now, I'm buying a brand that's going to escalate in value, but at the same time, I can buy the same thing for cheaper and get just as good. So, is it something we could do? Yes. Should we do it? I don't know. I have to dig in a lot more. But of right now, this would be what I would target for this week if we're buying. And quite honestly, we're not buying tomorrow because I got to figure. I think the best advice I've seen in the last week is worth investigating, or at least it worth considering. Buy the dip, and then don't worry about it. I think that's great advice. It's just depending on how much money you have, depending what's already in your portfolio, pending your strategy, pending how you want to do it, that requires a little more thought. It also requires thought going forward. If you hear the little purring in the background, that's my cat. But I think there's more to it than just buy the dip and leave it out, right? Or buy the dip and forget it. So it all comes down to strategy and where you think the market's going. It comes down to strategy and access and your funding and all of those things. So on my end of things, buy the dip sounds like good advice. I got to figure out my portfolio with Webull if I can transfer it out. I have to look into these two funds a lot more and figure that out. And then I don't know, maybe by end of week we buy another round of funds. We'll see. So I don't want to, I really don't. I will gladly take more of your time, but I don't want to waste your time. And I've got research to do. But whatever I end up doing, whether I buy or don't buy, I will put on the next video and I will explain what we did and why. And then you can have your opinion of whether that was a good decision or not. So if you like my content, consider subscribing to my channel. And if you like my content, help me hack YouTube. Leave me a comment, share a video, click the like button, ask a question, share what you're doing in the market, share your strategy. If you want to find me day to day, yeah, you can comment on this video. You can also find me on Facebook in the Navigate Your Finances group. And otherwise, that's all I got. This is a very unique buying opportunity. And I do think we should take full advantage of the buying opportunity. How you do it, how you go about it, really depends on your strategy, your money, and your portfolio. So I don't know. Leave me a comment. Say what you, I'm trying to figure out what my cat's scratching. Leave me a comment. Share your strategy. Share your rationale. And yeah, let's talk and help each other. So whatever you have for the week, I hope it goes well. And I will see y'all on another video. Have a great night, everybody. Bye bye.